But let's get back to the markets, and Aussie 10-year bond yields have crept past 1.25% over the past month or so. Our next guest isn't phased by its effect on equities though, and because of it, the bubble has moved, more room to run. To explain, Paul Ashworth joins us now from Cameron Harrison, live via Skype from Melbourne. Paul, good to see you there. Absolute level of bond yields, particularly 10 years, are still very low in the scheme of things. But when it comes to concern for markets, is it the level or is it the speed that they move that worries you the most?
Guys, it's really where we are in terms of the real yield. In that respect, policies looking to reflate in terms of growth and a little bit of inflation. We're seeing that reflected in absolute yields here and to a lesser extent offshore. We're seeing some headline inflation increase. Consequently, real yields are not moving that much. When we put those two things together, we think that is broadly positive for the equity market, and we can see that in terms of particularly correlation between market and real 10-year yields since the early 2000s. You can see it there in front. This is what we want. And this plays into reflation into the broader economy. And as Dean was talking earlier in terms of earnings growth, for well-run businesses. Yes, we think it's broadly positive.
Okay, so no bubble trouble. However, there are some very elevated valuations out there, some justified, perhaps some not. So, as we approach earnings season here in Australia, how do you go about digesting the reports? What is the biggest metric for you in some of the investments that you are looking to either hold on to or get into?
Sure. So, in terms of the investments that we've been particularly focused on through 2021, they're smart industrials. They're industrials that have taken on strong efficiency and productivity improvement, but they come with very sound, robust balance sheets, but with a particular focus on not being heavy in terms of fixed assets. So if we look at, we operate in the US, UK, Australian equity markets in terms of our equity strategy. If we were to pick some stocks from each of them, Illinois Toolworks in the US, coming in from current PE of 31 times through to 24, 25 times. Strong earnings uplift off its industrial base. In the UK, Croda International, very clever in terms of additives and the technology for paints and chemicals. In Australia, a business that we've increased weight over the last 2 years, Reliance Worldwide. And one that is in the news this morning is Vocus, which we doubled our weight to early last year. In terms of high quality, strategic, long-term assets, with an excellent management. So, what is common across all of those is sound financials, but that only takes us very much part of the way. It's excellence in management, and when we look at something like Kevin Russell, we can see that there's been a great transformation there.
Paul, where do you stand when it comes to the growth sectors, particularly technology? We know that in terms of proportion of financial markets in the equity world, they've grown substantially over recent years. Do you want to go and hold on to them these levels, or should you be very concerned about the valuation effect if we do start to see those yields drift higher?
Good question. Look, at the end of the day, the combination of monetary policy, fiscal expansion, and this broader base of economic uplift and a broad base of earnings uplift should hopefully, in the event that there was a substantial deflation in those growth and technology valuations, that capital should be able to be reasonably dispersed. Whilst not exactly equity based, if we look at a few years ago the run up in Bitcoin, we saw that collapse. But capital is able to disperse itself reasonably well and reasonably efficiency, without a significant flow-on adverse impact to markets. So I think the same is true here. I think there's enough happening in terms of the broad-based economy and other elements of the equity markets that if technology were to come off or significantly deflate, this would probably be a reasonable time for that to occur.
So, Cameron, just to wrap it up, if you're talking about rising inflation, talking about key, economies growing quite well, plenty of reasons to be still fully invested in the market, when do you potentially start becoming concerned about a taper and a taper tantrum, or do you think that central banks will avoid that at all costs? Even if they try to, are they capable of it?
I think they are capable, and I think we've been seeing that for the last few months. Again, we saw it last week in terms of Governor Lowe. We've seen it in terms of Jerome Powell. We'll see it again midweek from him. They are strongly putting to the market that this is a 2024, if not later, where central banks will look at either absolute settings of interest rates, but also in terms of their support, in terms of bond buying programs. So they look fairly coordinated in terms of the key central banks, at least for the next 2 years. But as you point out, I think through 2022, if we do see some inflationary expectations, really getting in advance, and we start to see some of that wages pressure, and COVID not come under control, then inflation really could start to spook the markets, but it's difficult to see that over the course of the next 18 months.
Things could get interesting in the period ahead. We're going to be very interested to see what happens with that inflationary pulse and how central banks respond to it. Paul Ashworth, Cameron Harrison, Chief Investment Officer, thank you for joining us on the program today.